Hey guys, welcome back to the channel. I hope everyone is doing well. So originally this topic was about return on capital, but then it kind of turned into like something a lot more serious. So I just wanted to tell you guys about like the financial fairy tales that are out there and the scammers that tell them. And I want you guys to watch for hidden risks in high yield ETFs in general. So anything like JEPY, SPYI, Defiance, YieldMax, etc. Now, does this mean like you go out and sell everything all at once? Of course not. Not what I'm saying at all. I'm just saying that there are risks out there, and I think you should pay attention to them. So there's a lot of high yield scams out there, and this is one way to help kind of maybe dodge them or at least like mitigate some of the effects. And just as a trigger warning, I was accused of being a sexist by attacking ETF Barbie's flawed arguments in another video, and I will probably be accused of math microaggressions pretty soon. So just to let you know, I'm probably making a lot of enemies, and it's not my intent. But when I see something that's not good, I got to warn people in the community. So the first thing is that there's no free high yield lunch out there. If there was, why would they share it, and why would they hurt themselves? So there's plenty of like nice people on social media that want to help out, and like they kind of overly promote things. And I think that high yield ETFs are a good thing in general, but sometimes like when the yield is too high, like that you should be kind of like, wait a minute, there's something probably not right here. Unfortunately, I think like some of these folks like they mean well, but I think some of these folks are probably not in the best shape like financially, and they keep moving around from like one grift to another. So I've noticed a lot of people like they kind of like they change like their focus like midstream. So like there's a lot of like folks that were into like copywriting, crypto, drop shipping, email marketing, forex, geopolitics, and NFT, and just like general trading, and then like this whole work online, and it's like one big amorphous mess. And I'm kind of guilty of a little bit of this myself because I'm trying to find like different like revenue streams like in the future for my own retirement. And did I leave anything out? I mean, there's so many things that are out there, like people just like move from like one scam to another. And unfortunately, I think like the high yield space might become one, and I'm hoping it won't. But let's just set expectations. Like for the reference, this is probably one of the best funds that I've seen, and I think most of you have heard this out of this by now. Now, like, this 1988 fund started in 1988. It's called the Medallion Fund, and this is based on the book from The Man Who Solved the Market. So Jim Simons, like this is probably one of the most ridiculous returns that I've ever seen. For over 30 years, 66% return, like gross. And then even after all the fees, it was still like 39%, which is pretty darn amazing. And this is, again, the book is called The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. The author is Gregory Zuckerman. So you can read this like at your own leisure. And I think it's a pretty good read. I think the next best documented returns is probably Stanley Druckenmiller, 30% plus, like over, I guess, like, at least like 20 years. And I want you to think about this. I know like sometimes like the high yield space gets a lot of hype because like, oh wow, look at the yields and they're fantastic. But keep in mind, like just like for example, like YieldMax, the best, well, I guess like the longest fund is the TSLY fund, and it's like over like a year or so. And then there are other funds that are been out for like a few months, and like the yields look really good, but you have to take a closer look because think about it, like if the best hedge fund manager in the world is only able to manage 66%, and that's gross by the way, uh even like on a net basis, like 39% is pretty darn amazing, and this is over like a long track record. Don't you think there's something a little bit fishy with some of these funds? And just for your reference, like I think for myself, I'm probably the least like scammy high yield channel. I know like some of my previous videos that they might be a little bit clickbaity, but I would say like on average, I'm probably the least scammy. And Well, then your next question is going to be, well, how do you know so much about YouTube scamming? Well, it takes one to know one. So I've been in the high yield space for, I guess, like a few months, and the more I learned, like the more, like I didn't realize how bad it was until I've, doing my own research. Like originally, I wanted like I wanted the high yield space to perform just because like I want to outsource some of my own trading to some of these ETFs. But then like when I look around, and I'm not happy about what I'm seeing. So sometimes it takes a criminal to catch other criminals. But at least I'm upfront about like, some of my own missteps and most of my other shenanigans. Now, like I guess like when I say scammy YouTubers, I think the ones that are optimized for views, like in like retentions and that sweet ad revenue, they're overly produced, and these videos like from a production standpoint are pretty good, but that requires a lot, some sound engineers, like video editors, and some high-end equipment, and it's pretty time consuming. So I'm wondering like how the heck do they have time to like invest and trade like for their own accounts? And I'm guessing most of these channels like they're optimized for like marketing. So some of these folks like I think they copy from like other YouTubers that are successful. And you have to keep in mind YouTube is still like a marketing platform. So first they try to, they try to impress you with like their knowledge, and they try to sell like these cheap products online. But then once they get your email address, usually what happens is then they start upselling you to like these like crazy packages, and then like consultations and seminars and all this other crap. And I find it quite ironic that passive income requires like this much work. So anyway, I think like a lot of people in the space are kind of probably in it to fake it until they make it, until they get like this like large like subscription base, and then they do like the whole marketing funnel thing. But fake gurus in general on YouTube, I mean they're pretty bad, but there's even bigger ripoffs if you can believe it or not. So I would say in general, Wall Street is just littered with legal theft, man. Just because like they have so much money that they can kind of pay off like politicians to kind of move like the regulations like more into to their favor. And of course, like I'm not even like counting like the bailouts that happened in the past. Some of it was just like quite ridiculous, but I'm not. I mean, that's like another topic for another video. And it's not just confined to like Lower Manhattan either. There's plenty of like financial predators online. I would say like the high yield community deserves a better class of criminal, and I'm gonna give it to them. So why so serious? Well, think of like I know like some of you that have been trading and investing for a while, like you'll hear like a lot of folks like complain about evil market makers. Now, I wouldn't say like market makers are angels, but I wouldn't say they're quite evil. I mean, this is old news. Like most of us on Wall Street, like we're not like in some back room somewhere going, "Muhahaha, let's screw over like real retail traders." It's not the case at all. I mean, we're just trying to make a buck. Now, sometimes like some people like they bend the rules, but some of there's actually some benefits too. Like I'll try to explain. So quantitative trading has been around for like a while now. So high frequency trading and payment for order flow is old news, and it's not as bad as you think because like there actually is a side benefit of this. Like remember what market makers trying to do? They're just trying to make a like the difference between like a bid or ask. So and most of them like want to do this in volume because like if you're only making like a penny per trade, like you have to do a lot of this like and do it frequently to make it worth it. So like if you're a retail trader or like a small time investor and you want to avoid getting ripped off, just use like limit orders. So this way you can save yourself some grief. So anyway, like structured products. Now this is a pretty, I would say this is probably one of the biggest scams out there. Again, this is not new, but they come in like different forms. So usually what a structured product is like it's collateral is like a pile of bonds that are collateralized, and then you add like a extra extra yield on top of it. And if this sounds familiar, this is similar to how like YieldMax and Defiance is structured, but I think their setup is probably better. And I'll explain. So this is like a example of an annuity that I found online. So if you notice, like some of these are actually most of these on top are treasury products. So like you start from like notes all the way to like long bonds. So these are like 30 years plus. And then you'll notice like these like funky products like centrally cleared total return swaps. So this is adding like their yield on top of like treasuries. And I guess I want to also warn folks that are kind of on the older side and you're looking for like a more reliable income stream. Please be very careful if you decide to buy any of these annuities and make sure like you're comfortable with like things like total return swaps. Because I think like treasuries, I think most people are probably okay with this because like these are pretty easy to research. But like these total return swaps, I mean, you don't know, what's in them or what the terms are. And just in general, like structured products have been around overseas as well. Like Asian and European investors had these for a while too. So these are nothing new. So then the next thing I want to just like caution people about is that you want to think of ETFs and stocks as just like financial inventory. In the old days, at least you get like a certificate or like a actual like physical bond with actual coupons. And at least like if something bad happens, at least have something physical to kind of hold on to. But nowadays, most of this stuff is just like electronic digits, and then it's not worth falling in love with like a digital abstract. I mean, this is just a business, and you should treat it as such. If something's like, let's say you bought like Tesla at a really high price, and right now you're not feeling so good. Well, you have a few choices. Either just like hold on to it until it can recover some, or you could just like say the heck with it. Like at some point, like you get sick of like looking at like the losses, and you can take the loss temporarily, and then what you can do is you can offset like the loss with some other gains like later on. But of course, like it's up to you whether you want to keep them or not. I would say, look at my personally, if ever like if an investment goes that bad for me, usually what I do is I just dump it and then look for something else that that might like fill in the hole. And I just want to say like Wall Street loves ETFs and structured products because like proprietary trading, even though like it could be profitable, it's also very expensive because you need like co-location, you need low latency. So co-location like meaning like they have to put like their servers directly to next to like the actual exchanges themselves, just so you can get an advantage over others. And then you also need like a SWAT team of like STEM majors, science, technology, engineer, and math majors to collect and clean this data. And then this also requires a lot of back testing and analysis as well. And then also on top of that, then you need like the risk management teams, legal and accounting to kind of sign off on certain things too. So that's like another layer of cost. So why does like Wall Street love ETFs and structured products? Well, most of them just like charge like a fee, and most of the time it's recurring because most retail investors are either too careless, lazy, or sometimes like they're just tired because like when you come home from work like you're in a bad mood and you need to take care of your family and then you need to take the dog out for a walk and all this other stuff. By the time you get all that stuff done, you're probably not in the mood to like research ETFs. And I think this is what Wall Street is counting on, that just like everyday life, it's kind of like a struggle sometimes. And you think, oh well, once I buy the ETF, most of the time you're not gonna take care to like see like what's actually inside them. And most people will just listen to it like any talking head on like either CNBC or like YouTube or whatever, and most people won't take the time to explain to you like what the hidden risks are. So why is Panda here in the high yield space? Well, there are some good bargains out there, and there are some I think like just because like I'm saying that there are risks, that doesn't mean there's no opportunity either. Because remember, like the higher the risk, like the higher the opportunity. But you have to do like your homework and see which ones are worth your time. And sometimes it's unfortunate that you have to rotate sometimes, but that's just like part of the game. So I will only dump on the dum-dums. Loyal subscribers will be spared because I'm gonna try to steer you in the right direction. And then my other plan is like if they ever get so cheap that they become like outrageous bargains, then I'll like step in again to kind of prop up the prices. And again, I want to reiterate that risk doesn't magically appear. So just think about it logically. Like, why would any investment bank, market making firm, or like any quantitative fund want to take on retail risk? Of course they wouldn't. You have to think about who's on the other side of your trade. They're gonna dump the risk on someone else like the first chance that they get. So what would be a good example of this? So I've covered like ISPY before, and I'm just using this as an example. I'm actually okay with this fund just because like they're using Goldman Sachs as like the kind of as the counterparty for all their covered call trades. So this is also in the form of a total return swap, or at least I think that's what they're doing. But I want you again, think about like what's happening on the other side of the transaction. Do you honestly think that Mr. Goldman Sachs wants to take $27 million of simulated retail covered call crap? Of course not. They have to you have to think about what's on the other side. So if we're short calls, that means they're long calls. And do you think they want to take that type of risk? Because if you're buying out of the money calls, that means you don't have a very good like chance of like making money. They need to flatten out this exposure by either shorting the SPX calls, shorting ES futures, or shorting the liquid stocks in like the index themselves. So, and this is called dispersion trading, or one form of dispersion trading, and that I'll revisit this in a few slides. And then also, there's another popular fund called JEPY. I think most of you have already heard about this, just because it's also like a large fund, and a lot of other YouTubers have covered this, but I don't think they really covered this in detail. So for example, they don't actually do like an actual cover call like how YieldMax and Defiance does it. So at least at least with sometimes I'm critical about Defiance and YieldMax, but I do appreciate the transparency. You can actually track their individual trades like for most or in fact like all of their funds so far. And I want you to think about something here. Like JEPI is using something called equity linked notes. And if you look at either the prospectus or any of their marketing materials, you won't be able to see like what's actually in the equity linked notes. But again, just like as an example, this is like 3.7 million. Actually, no, excuse me, 3.7 billion worth of retail cover call crap. Do you think that other counterparties want to be long out of the money calls? Again, no, they won't. Like they have to like for example, if you're in the fund, that means you're synthetically short calls. So on the other side, like whoever JP Morgan is working with, those counterparties have to take long call risk, and they're generally like out of the money long calls too. So unless like the market like shoots straight up, those counterparties are on the hook. They don't want to lose money. So what do you do to hedge these like long out of the money calls? Again, they're going to short either XPS calls, short ES futures, or short the underlying stocks themselves. So just to continue, like if you look through like their either the prospectus or like the annual reports, you'll you'll see like some of the detail. And the first thing, of course, you should notice that the cover calls are actually through equity linked notes. So on the right hand side, so these equity linked notes, at least the good thing here is that they're using like major counterparties. So for example, Barclays, BNP Paribas, Bank of America, et cetera, et cetera. So at least like they're using, large, well-known banks. But think about it, if you're not JEPY, and who knows like what kind of counterparties they're using. So at least like for JEPY, at least I can say that they're using well-known counterparties. But here's the problem: what are the terms here? I mean, I think it's great that they're saying it's linked to the S&P 500 index, but what about like these other terms? Like, I mean, 40%. I mean, that's a lot of money, but like, what is that in reference to? Like, how's that calculated? But anyway, and then there's also like yeah, I hate to bring this term up, but like it's a incestuous relationship because look at what they're doing with their some of the cash. So they're using like something called the securities lending money market. So this is like within like JP Morgan, and then they're also using like a US government JP Morgan money market fund, and then they're also like lending out like some of the securities for extra money. So again, like they're lending out like the money that you put in to buy stocks, but they're also lending the stocks out to other people to short. So you're it's like almost like it's kind of like this weird relationship here, and I want that to be to be known. Like people like when you're investing in these type of ETFs, you want to like take a look and see if you're comfortable with this type of risk. So let's say heaven forbid that there's ever like another financial crisis. Well, they're kind of you're if you buy into this type of fund, you're stuck with basically JP Morgan. Now, most likely, like because they're so politically connected that they can like survive out these type of crises. So, but I don't know, like you just don't know what else is on like the books in general. So if you want to take that type of risk, I mean that's fine. I just want you guys to be aware of that. Again, like this is another even bigger like JP Morgan fund. Like this is called like the hedge equity fund, and they do this like quarterly rebalance. So they have like this. It's an interesting fund setup. So like they're basically doing a cover call, but they're also buying a put spread. So in case like the market tanks, they can recover some of the cost of that. But this is bad in a way because this is like a form of volatility compression. It's bad for like the overall space in general because like if this fund is like short volatility, it creates like this vicious cycle of effect because like in order to get like a certain yield, you're gonna have to either short more contracts or you're gonna have to like take create like a cover call but like that's closer in the money and that doesn't give you a lot of wiggle room. I mean there's plus and minuses. If you do like a tight like cover call, like uh you won't get much capital appreciation, but you'll get like a slightly bigger credit to give you a cushion. But guess what happens when the volatility explodes? I think you can kind of like think this through for yourselves. And in fact, I encourage you to kind of like think things through. I don't want me to, I don't want to like kind of like spoon feed people because that's not good in the long term. Because like, what if I decide to like fully retire and then who else is gonna try to explain this type of stuff to you guys? And then also there's another thing that I'm a little bit concerned about in the overall space. Right now, like correlation between like different stocks within like for example like the S&P 500, it's pretty low, which in general is pretty good because like, that means like you have more chances to diversify. But how long will this last? And like what happens to your favorite stocks ETFs when like the correlation heads to one? And that's really bad because that means like there's really no benefits of diversification if everything is moving in the same direction at the same time. And usually that direction is down. So I just want you guys to be aware of that. And then here's a helpful hint. Keep an eye on like the correlation indices. Now you can find this out for yourself. I've brought this up in the past, but you can look at this up on the CBOE website. And then there's also another very interesting indice that again, if you want to do some homework, and I strongly encourage people to do their own homework, there's something called DSPX. Not a lot of people like bring this up, and this is called the dispersion index. And this is what I've kind of mentioned before. So I've linked some really amazing like podcast interviews in the comment section. So please take some time to listen to those. I know like sometimes they're very complicated and it might seem like it's over your head, but please be take some time to listen to them because it's very important. Because they're related to like something called index arbitrage. So in the old times, like the basic concept of this is like, let's say you see like the S&P 500 index and it's very undervalued compared to like a overvalued basket of stocks. So what you would do is you buy the underlying index and sell the overvalued basket of stocks. Because think about it in theory, like the S&P 500, if you add up, let's say like you buy like one share of all the stocks in like the S&P 500, in theory that should equal to like the like what you can get from like let's say like an ETF like the SPY. So that's like the basic concept. But now there's a very interesting form of this type of arbitrage. So you can buy, in theory, if you ever see like the index volatility, if it's undervalued, you can buy that, and then you can sell overvalued stock volatility, and vice versa. So I know this is like a very like a funky topic to bring up, but like if you pay attention and like you kind of go down like the rabbit hole, I think it's really worth it. Um, I guess like the TLDR, the too long didn't read for this is like you want to watch out for a counterparty risk. You also want to watch out for dealer risk, and then you also want to pay attention in terms of like institutional risk dumping, because once you understand this, then this will help improve your own trading and investing. So, like, how does this relate to Defiance and YieldMax? Well, you'll notice, like, for the Defiance funds, most of them are index-based, and then also, like, the YieldMax, these are individual stock names. So, in theory, again, if you understand just like half of what I said, there's a chance to alternate between like the index and individual stock products. So you want to pay attention to this type of material. I know it's hard to fathom in the beginning, but then you once you start understanding the relationships, oh my goodness, there's so much alpha in here. And this is why do you think like the big Wall Street firms are interested in this type of trading? So anyway, I know like the for the Defiance and YieldMax ones, there are some yellow flags. Originally, I started this off as like a return on capital video, but then there's like so much more to this. There's more risk, but then again, like the flip side to this is since there's more risk, there's more opportunity to be had. So anyway, so I just want to say like in general, like the Defiance and YieldMax, even though like I give them like some flack sometimes, I just want to say at least they're using like treasuries as a base. So, and then like again, like they have pretty good like a daily breakdown. So I guess I just want to say that there is some pros to this too. So I think in general, like the high yield ETFs, like there's definitely like a convenience element. I know for myself, like sometimes I can't trade like everything that I want just because like there's so many products, and then they're also like pretty capital efficient, inefficient. Like for example, if I wanted to trade the SPX, like some of these like the individual options are just way too expensive. And I think like the Defiance definitely offers like a pretty convenient for product for most folks. And then actually in some ways that might save some fees for like smaller accounts too. And, and that these ETFs have generally have a very good transparency. But then also like at the same time, like the risk would be that there's like higher they're generally on the higher side in terms of expense ratios. And then the one of the bad parts is that like you can't pick like the option strikes. So we have to kind of like modify this ourselves with our own like option trading. And then one of the I guess like the major risks like so far has been like the implied volatility for a lot of these funds have been collapsing. And one of the reasons why is because there's actually too many products that are very similar, and they're all like short volatility products. So just be careful about that. And then the other thing like the yields won't be consistent month to month. And then now the predators are starting to sniff around like the high yield space. So just be careful about that. So this one was I think like a pretty dense video. So I just want to thank you for watching all the way to the end. And then for all my new and old subscribers, thank you for watching. Thank you for sticking with me. I try to bring out topics that most other YouTubers in general in the finance space don't cover. So I really appreciate your viewership and thank you for watching. I hope you guys make some good money out there and please do your homework and I'll see you in the next video. Bye now.